actually work. Do is list the goals. Just look at whatever your goals are for you and your family. If you have a family, or even if you're planning to build one, right? And then you get personal. Because of course a goal is much easier to attain, or when you list the vision, if you talk about why you want to achieve that, right? So also look at and prioritize your list. What things can you knock out that are easy to attain? Then you have a timeline to that, right? And that'll help you stay on track. And then just do the math. So how much money do you need to save, right? And it makes it it's easier to step by step to do that, right? So first thing we look at is paying ourselves first, right? So if you look at your average annual income, right, and you multiply that by the number of years that you've been working, and then that equals the total amount you've earned, right? And then look at how much do you have in personal savings, and then just divide D by C, right? So that actually will show you the percentage of your income saved. Take a picture of that. That's homework. You can do that, and of course we can do that on an individual basis as well. I meet with families all the time to go over this. So everybody needs 3 accounts. If you don't have that, there's ways that you can do that. Emergency account, 3 months of income for the next 0 to 2 years. That's very important. So many people are living paycheck to paycheck. So we want to have some emergency account, a short-term account, which is a minimum of 6 months income for the next 3 to 5 years. And then you have a wealth building account. That's an account that you're saving that you don't touch, right? You put money into it. That's gonna allow you to build and retire, right? So first thing, of course, is paying off debt. Now that is something that's very attainable. And one thing that what can happen is those credit cards are crazy, right? Just think about it. If you make a one-time $3,000 credit card purchase at 18%, and just making the minimum payment, it will take you 10 years at least to pay that off, right? With over $2,000 in interest charges. A lot of times we don't think about it because we want that in the moment, right? So definitely, if we're doing this, we have these type of habits. The question is the power of compound interest working for you or against you? In this case, it's working against you. Absolutely. So one of the things we also look at is revolving debt can erode your financial security. So if we're constantly maxing out those cards, right, and then we're just paying the interest on there, that's where you can find yourself into a hole. Right, so that's looking at the revolving debt. If we have $17,000 at 18%, right? That's about $600 a month. That's $12,500 in interest that you're paying in 17 years. We don't think about how much money is going to interest. We just paying those bills, right? So having a fixed debt, if we reduce and work on one bill at a time, that's the same amount of money that's going around. You can pay less than half of the interest in 3 years and 2 months to do it. So just having a plan to do it. So what we do is we promote debt stacking, where you take one credit card and pay that off, and then put that money that you were paying on that card to the next one, to the next one, to the next one. What that does is it makes the goals easier. And of course, our goal is to really pay off those cards, right, with a higher interest. Then look at the car loans, and then the mortgage. That's the ultimate goal, is to just really be at the mortgage, right? So if we do that in a way, versus just putting a little on everything, you're just paying interest, then you get it done faster. So the power of debt stacking is you can pay your debts, you can pay your bills off in this example in 9 years versus 24 years, right? That's the power, because of course that can free up money to do whatever you need to do. If you want to sow into someone, if you want to sow into the ministry, if you're not constantly under this debt, it makes it much doable, right? So, also the power of, when we talk about interest, thinking about the rule of 72. A lot of times we think about interest, just how interest we want to be is working for those credit card companies and the banks. We can show you how it can work for you. Check out this short video that actually breaks down the rule of 72 if you haven't heard of it. Albert Einstein developed this simple formula.
$297,367 at a 3% interest rate. At a 6% interest rate, it would have grown to $572,734. But if you would have received a 9% interest rate, your money would have grown to $1,185,539. That's the power of compound interest. Your money can earn you more money just by being in the right place. To discover your financial independence number is to learn how much money you have to accumulate through saving and investing in order to one day live the quality of life you want without working anymore. The financial independence number is the most important number in our financial lives, and yet most people have no idea what it means or how to attain it. We have a digital tool that makes it easy to discover, and really that digital tool can help clients navigate their entire financial journey.
So that number, again, that financial independence number is huge, right? So you'll be able to know just where you're going. And a lot of times people think about, I got my money in the CD or I got my money in the bank. Most banks, they're giving you 1% and 2% interest, maybe 3% if they're at the most, right? So that's why knowing where to put your money is so important, right? So doubling your rate of return can quadruple your savings. This is what they were just talking about, right? Just $100 a month for 45 years. If we're looking at that low interest rate of 4.5, which is really generous from the banks, versus that 9% interest rate, which is the average of our clients in our brokerage, it's $746,000 over that 45-year period, which is huge, right? Just putting things in the right place. Saving versus investing. You want to save for your goals in the short term, but also invest for long-term growth. So it's just definitely just the ways you're looking at to save your money, preserve it. If you have a plan, then you can do it. This is a Fortune U.S. bank. You don't have to find a large amount of money to put away. We have some folks who invest $25 and $30 a month. So that is not something that's way out there. A lot of times that's a big myth, right? And then unless you're independently wealthy, you should always be putting away something towards retirement. One other thing, of course, is buying the right type of life insurance. Now, of course, we want to make sure, our cars, we all have insurance on our cars. That's mandatory, right? So and the car is worth it. You're definitely going to insure it. Our home is important for us to have, and mandatory for us to have homeowners insurance, right? Yeah. How much more is your life, right? Think about it. We actually bring home paychecks every 2 weeks, some of us monthly, and that income, of course, is huge as well. Right, because we're going to make sure that, God forbid, if something were to happen to us, that our families are not out there not just having to bury us, but thinking about our income, right? So that's our purpose. We talk about income protection, right? So now there's all kinds of stuff out there. What should you buy? The inexpensive term life insurance. Why? Because what happens is that's going to give you the most amount of coverage for less money. And then who should buy it? Of course, the people who are have other people dependent on you. So everybody, at some point, in some form or fashion, has somebody who depends on them, right? So what happens is, a lot of times people we don't think about it, but in early life, in the early years, but especially when you have young kids, you have high debt, you have a house mortgage, and the loss of income will be devastating when you're younger, right? As we get older, and our children are more or less dependent upon our income. So you have some people who died too young. You have some people who lived too long. And then in the older years, we need money to survive, right? So we're looking at a financial plan, looking at something that's going to address both ends of that spectrum, right? So a good rule of thumb for life insurance is to have 10 times your annual salary. And that's because of course if something were to happen, you would at least want your family to survive over 10 years of your income, right? Now, cash value life insurance. There's two different kinds of life insurance. You have cash value, you have term. Cash value life insurance has a lot of it's normally a higher premium, right? It also they do is they take your life insurance and investing and they bundle it together. In most plans, so traditional cash value policies, you're not going to be able to get the cash value and the death benefit when someone deceases. You don't get both. Most plans, what happens is when the deceased passes away, the company keeps the company keeps that death benefit because it's a savings component, right? It's a living benefit. So term, lower premium. It's no investment that's bundled with it, so that you could control your own investing on your own. It's pure death protection, right? So that's why it's important, have that on the front end. Now, how do you know what you're paying for? The answer is, of course, it's hard if your life insurance and your investing is bundled together, right? Because you have things like universal life and index universal life, variable life, where you don't see where your money and your investment is going to, because the reality is it costs more to insure us every year because we get older, right? So what happens is with those type of products, the older you get, the less your money is going towards your investment. So that's why it's never smart to have those type of plans, right? So we always say never buy life insurance as an investment. Keep your life insurance is separate from your investment. Just kind of similar to like car insurance. You don't have an investment, with your car insurance. Definitely, you don't want to have that with your life insurance as well, right? So now here's an example. So we say never buy life insurance as an investment, but buy term and invest the difference. You have a whole life policy where you have a $100,000 whole life policy. The death benefit is you're paying $123 a month for that, right? Now, what happens is when you pass away, you either get the death benefit or you get the cash value, because it cancels out the other. What we ask, a smarter method is buy term and invest the difference, where you can spend that same amount of money monthly, right, and actually only spend $58 a month on life insurance, and that frees up $7,782 to invest each year, and actually getting three times the life insurance, $300,000 term life insurance plan, right? And then by the end of that term, the savings has grown to over $183,000 by age 70. So it's almost double the amount of savings that's in that particular model. It's a warning. Yeah, a lot of times we see have a lot of stuff on there, misinformation on Instagram and different places. Cash value life insurance, it may not be right for you. Definitely beware of cash value, whole life, permanent, universal life insurance, variable, index, infinite banking. Those things, what they're designed to do is put more money back into the insurance company, less money for the client. It's actually more, and the agents are making a higher commission on those type of products, right? So if you own on those products, or you've been approached by somebody, definitely need to get the facts, right? So cash value it grows tax deferred, but it's not tax free. And then living benefits are not exactly what you might think they are, because what happens is, again, they're only active while we're alive. That's why they're living benefits, right? And then of course it takes many years to build the cash value. And most of the time, if you look into the fine print of these policies, the surrender charges are much higher. So the first few years of the policy, you're paying, all the money is going into the commissions and fees to the company. There's actually no cash value at all. And then the interest rates are much lower, right, than an actual investment. So, for products with cash value, it's expensive, and typically provides less coverage for your family, right? And so less coverage means at the end of the purpose of life insurance is to protect the income. If someone passes away, then you have less of a benefit for your family. And then you have to borrow on your own money. That's crazy. Borrow your own money, and plus typically has a low rate of return. So you lose your cash value if you die on the traditional policies, right? So in certain instances, you can only get your cash value if you're paying extra fees to get your own money, right? So take an example, because these are very popular, index universal life policies. The face amount for this couple, John and Mary, at age 35, $250,000. They're paying $251 a month. By the time they reach age 65, their cash value gets to $127,000. So think about it. They're paying $251 a month for 30 years, and that's the amount that they're saving, right? So with this same $251, you can get a term policy, right, and paying $88 a month, right, for the same amount of coverage, and then invest that $163 in a Roth IRA, and actually is growing at a rate of 9%. By the time that 30-year period is over, the savings in that Roth IRA is at over $300,000. Much difference, right? So definitely want to make sure that we make sure that they understand the facts. Because a lot of stuff looks good and it sounds good, but when you start looking at the actual numbers, they don't lie, right? So the bottom line is you can do it, right? So yes, sir.
Quick question on the floor.
I wanted to know, as far as is the term life the same as the cash value, like life insurance?
So both of them will, if someone passes away, it's going to pay out a number, right?
Okay.
But what happens is the term is just the death protection. It's pure life insurance.
Okay.
The cash value tries to put together a savings and life insurance together.
Okay.
But what it's doing is it's giving you a much lower rate of savings. And with those whole life policies, when someone passes away, the cash value is gone.
Okay. And isn't it a certain age limit? Like some term, they say after that, after you reach 70 or 77, then that's it.
So the way term insurance works, exactly how it sounds, is for a term. It's for a certain number of years, so whatever long your term is. So we have anywhere between like 10 years up to 35 years.
Okay.
The cost of life insurance, and this is any product, is based upon your age and your health.
Okay.
Yeah. So.
Okay.
What happens after the term?
So in most companies, after the end of your term, that's the end of your insurance. There are some companies like ours that actually our clients are able to still qualify for the same amount of coverage without having to prove insurability and get another term if they want to. But of course, our goal is to help our clients with their investments. So by the time that they reach that end of their term, their savings has grown, so they don't necessarily need as much life insurance. Because by the time you're older, your kids aren't dependent on your income, so you don't necessarily need that $1 million policy when your kids when you're 65 and your kids are in their 30s or 40s. Yes.
So how long are these terms? Like, is it like for 1 year, or is it just like for like a given amount of time, depending on how long the policy is?
It's a good question. So it's anywhere between 10 years up to 35 years.
Okay, that's not bad.
Yeah.
Okay.
Yes.
So I work for mortgages, and so we always do. I'm going.
It's for online.
Okay. So I work with mortgages, and so we always deal with like term and cash value all the time with veterans because we're doing refinancing. So we always ask those big questions of, okay, so what does your 401k look? Do you have an IRA to kind of give them like that reality shock of your assets? So when we go to the term and cash value, and my company, I don't know if my company's great at this, but they prioritize and like the cash value life insurance because in that instance, that if you need money, you can draw from yourself. That term policy, all that money that you have in there, if your kids or was to pass away, you can't access that anymore. So it's really different when I'm looking at the presentation because in my company, they make it seem like the cash value is the more beneficial one because you can access your cash right here, right now, versus term policy is like it's only available if you're alive. You died, you kids ain't gonna have no access to it. So
Yeah, that's how it's marketed.
Yes.
That's how it's marketed. What happens is, and it's a myth because what happens is the one if you pull from your cash value, you're going to reduce the death benefit, which actually because say for example you have $100,000 whole life policy. You take out a $50,000 loan and you pass away and the loan has not been satisfied. The company's going to get their money back that they borrowed from you first before they pay out money to your family. If you have a Roth IRA and it's your account, you can make a withdrawal from your account versus having to take out a loan. Your life insurance is still intact. So you get so the family gets you're able to get both. That's why we encourage our clients, and we help our clients to get that mutual fund or Roth IRA, something like that they can that they're still growing for their future, and if they have an emergency that comes up, they can still pull from it, but it's not going to penalize your family if you pass away. Yes.
Do you want to go first? Okay, so since we're talking about that, sorry to ask another question. So you have these products, it's like, we got the cash value, whole life insurance, and 401k. Now, in my industry, they've talked about these debates in our office about how, 401ks in long term is like, I'm not going to use this word, but it's like a scam. Like, you're literally put into a 401k that when you postly retire, it really doesn't benefit you versus like an IRA. So with all these products that are floating around and all these misconceptions of what is a beneficial route, especially for people in the black community, what is the best product in your experience for black people not even just black people, just people in general to invest in that's going to help them sustain their life after retirement when they're not living paycheck to paycheck when you are retired?
Good question. We always suggest that you have some type of life insurance or some type of retirement outside of your job. You want to have a 401k. If you have a 401k, especially if your company is matching you, that's good. That's free money, right? But you want to also have a Roth IRA outside of the company as well, because there's huge tax benefits of having that outside of your job as well. So it's good to have both. I wouldn't say that not get the 401k, especially if your company's giving you that money. That's just smart. But we definitely want to have something outside as well. Does that make sense? Yes.
All right, so I have one quick question. So you mentioned this Roth IRA, right?
Mm-hmm.
So where exactly can we get it from? Do you prefer the bank or do you prefer somewhere else?
So I would suggest that you get, because most of the time the interest rate on the Roth IRAs are very low, like 3-4%. We actually help I would get something from outside of a bank, maybe if you have a financial planner. We offer Roth IRAs through our brokerage as well. Something that with the higher interest rate. So our company has done a lot of lead work and work with a lot of different investment vehicles to give you higher rates. Yes.
Okay, so beyond the presentation, knowing that you have all this knowledge, all this information, etc., and knowing that people, with their limited, I guess, let me try to phrase this into a question. So, with you and what you're doing, what is your why behind doing it, and where do you want to see, or how are you taking this a step farther to help educate those? I'm trying to understand, why do you do what you do? Not in questioning you, but getting the why behind what drives you to have these seminars, to get this education, why is the importance of it, and how are you taking to the next step to help people get empowered and make better financial decisions for themselves?
Good question. Yes. Our people perish for lack of knowledge. That's scripture, right? And so what we do is we take the information and empower our people to make better decisions. And in my experience, if you do right by your clients, then of course they'll do right by you. That's how our business has grown by word of mouth, because we actually treat our clients right, and do what's right by people. And instead of benefiting from folks by giving them something that is going to ultimately do them harm in the long run. So that's our why behind it. Like I said, especially coming from IT to financial services, it was huge, a huge step. Just why we did it is because shortly before we got licensed, my father-in-law passed away. He had stage 4 cancer. We were looking for life insurance for him, and it was too late. So I vowed to not let that be our story. Your man of God was talking about breaking the generational curse earlier, right? That's one thing that we wanted to make sure that we did for our family, and been able to empower others to do the same thing.
Shifting a little bit, just a question in terms of investment and also your background. I apologize, I missed the introduction. Are you a fiduciary?
So I am. Very good question. I am. My company is my brokerage is fiduciary. I'm currently studying for that. So I'm getting my license. I'm actually studying for my SIE. and then I'll be Series 6 licensed in the next couple of months. Yes.
Awesome. Can you define what that is?
So basically, I will be licensed to be able to help folks with their investments as well. So I'm life insurance licensed now, and then I'll be taking my securities industry essentials, which is the gateway to the Series 6, where I'll be able to help folks with mutual funds and IRAs and those the college savings plans, all of those.
And the reason I asked the question was because fiduciaries, they work on your behalf.
Absolutely.
And so, like, they have your best interest at heart. They're not trying
Absolutely.
to sell packages, benefit the company. They're looking at how do I benefit you.
Yep, and my senior partners who they are fiduciary licensed, securities licensed, and so that's one thing that the benefit. I'm in business for myself, but not by myself. I can definitely refer my clients to them, and then once my license is with the state, then they'll become our clients.
So I have one quick question. So in regards to the Roth IRA, right? So based off per paycheck, what percentage do you advise for me to actually like deposit into that IRA so that way it can grow, but at the same time I can still do my daily living, like pay my bills and just do everyday living?
So that's an individual question, and what we do with those is we meet with each client, each family, and do what's called a financial needs analysis. We actually look at your numbers and look at what you're currently doing, so we can give you recommendations based on that. We can definitely set up a time to do that with you. Yes.
It's not a question, it's more like a comment. So now that I'm learning, adulthood now, smacked me in my face really hard lately. So when are we going to start having classes for like 10-year-olds? Because I feel like if I knew what life really composed of, I would have started saving and all this stuff at age 10. So it's just a comment, that's all.
This stuff really should be taught in schools, right? And it's a crime that is not. I'm just learning about it in my 40s, right? I wish I would have known about it in my 20s or 30s, even. I know my son in PG County schools, they do have financial literacy class. I'm not sure what they're doing in Howard County, but yes, but I agree.
It's in some, it's not in every school.
Yeah, and one thing that we do is our office we do outreach to schools, and we do lunch and learns. If any teachers here, we can set it up for you to come to your school too. Yeah, yes. Yep. Absolutely. So that's on my next slide.
I appreciate it.
It's just there's a QR code. You can connect with me, and that's my mobile card. We can set up a time to talk, because definitely we got to make sure that we have a plan in place, right? So that's what we're here to do. Is we're here to help you. You can learn. We have also with that QR code. We have our Harmony Works book that really breaks down what we talked about in high level into something that you can read, download, print out, what have you, and you can get that from my card as well. Yes, sir.
You were talking about the financial independence number.
Yes.
How do you calculate that?
So that's something that we do. Yes.
Okay.
Yeah, and so we have a digital tool where we can plug in your finances, what you're making, what you're saving, life insurance, all that stuff. Put it all together, and you can actually know what your number is.
So, like with the financial independence number, right? Say, for instance, you're on a 9 to 5, but yet you're doing it like you did a business. You were doing your business on the side, so you knew what number you needed to say, okay, I don't have to do that anymore. I can do do that. So that's more of a thing of that's a you question. Like, what do you need to switch over to do your business full time? Right?
Absolutely.
Okay.
Yeah, I mean, for me personally, when I saw that my income from my business was matching the income that I was bringing in from 9 to 5, I decided that I would just to switch it over. Yeah.
Yeah, that's a good thing.
I have a question. So earlier in the slides, you said that it's recommended to at least have 3 accounts. And so, and that one account that you had on the side, it said to just save, you don't touch it, you just let it grow. What banks are, I guess, I mean, you can't trust no bank, but what bank would you recommend for us to place our finances into? Because, of course, it's offering good interest rates, but right now there's a lot of banks that are closing, or Silicon Valley Bank is kind of a little shaky there. We don't know if they're going to make it by the end of the year, or then there's PayPal, or what was that one?
The metal banks, the cash.
Yeah.
So those type of banks are good for managing your day-to-day finances. But as far as savings and emergency funds and stuff like that, definitely want to have some type of investment account outside of a bank, when we can definitely help you to determine the best options for that.
Now, what's the difference between is it high yield savings, high yield, and compound? Do you know that?
So basically, the compound is talking about the interest rate, and every type of account has compound interest. It's just a matter of what the higher rate versus the lower, right? So we can go into that, but I would definitely like stuff like a CD, or I wouldn't advise to get a CD or anything like that, because most of the times the highest rate that the bank is going to give you is about 3%, and that's being generous. And so we can get into. I know they talked a little bit about that on the rule of 72, but it takes basically 24 years for that money to double in a CD, and so you definitely don't want to wait that long. Yeah.
Do you have a account or a bank that you would recommend, or?
Yes. So we have a number of investment options that we deal with we deal with Fidelity, is one. We deal with Lincoln. There's a number of different companies AIG that we deal with. So we just a number of different companies that we partner with. That can find out the best fit for you. The reason why we don't, it's not one size fits all, because everybody has different risk tolerances when it comes to investing. Yep. Any other questions? Appreciate you. Yes.
So how much do you charge personally for your services?
So again, I'm not a financial advisor. If the financial advisors actually pay you actually charge you by the hour, right? So to just meet with us. Yes, financial advisors charge. We don't charge to meet with us. The only thing that we do is we provide the service, and of course we make a commission off of whatever the service, if you decide to get a service with us. But as far as like sitting down and talk to us, that's free.
I know I need a personal financial advisor. I'm almost 30, 28.
Yeah, let's talk.
So it's about that time for me to be serious about my money.
Yeah, so we are financial coaches. My obviously we're a coach. We just help you, and so a financial advisor charges you for their time. A financial coach.
Like how much? Like $100 an hour or like $50 an hour?
So yeah, it varies because I'm not one of them. I don't look at like how much they charge, but I know they charge you just to sit down and talk to them. Yeah, we don't charge for our time. We just provide the service, and there's a commission for that. Yeah. Yes. The rule of 72 basically shows you how long it takes for your money to double in years. So if you take your interest rate divided into 72, it shows you how long it takes for your money to double. Yeah. So the video kind of gave you an overview. When we sit down, we didn't want to confuse you with the numbers, but that's really, it just takes how long it takes for your money to double in years. You can Google that. It's Albert Einstein developed that formula. That's like the banker's rule. The banks don't want us to know how that works. All right.
Can you talk a little bit more about how important it is to make sure that your level of insurance and your level and the times of that you're more responsible has to be at a place whereby your investment is coming up, while the level where you have a lot more responsibilities, mortgage, your mortgage and all of those type of things are coming down. So that's when your insurance level should be at its highest compared to when the time of the term life might be coming down or ending. You mentioned it, but I think the level, people need to understand, at the level of where you have a family, you have a mortgage, you have cars, you have this, you have that. That's when your insurance need is at its greatest.
Absolutely, absolutely, and it's something because when your children are dependent upon your income, you have young children and things of that nature. Like for example, right now my son's 18. He's still dependent upon my income, even though he's quote unquote grown. He's still dependent upon our income. He's getting ready to go to college. His college is where he wants to go. Is one of the most expensive in the state. So he's dependent upon our income. So that's why we have $2 million in life insurance on myself. But as you get older, they're grown and they're on their own off the payroll. They're less dependent upon your income. So God forbid you pass away. Here, you said never off the payroll. Never off the payroll. Well, yeah, when your mama may have, papa may have. God bless the child has his own, right? But so they're less dependent, and so God forbid, something happens. Really, the need for savings is higher. But what happens is while you're saving and while you're investing, if you don't have life insurance, then God forbid if someone passes away, then that savings is probably not going to be matured enough if you don't have something to protect the income. So that's why we focus on both ends of the spectrum. Yes.
So just in your opinion, depending on age, is term life good? If you for instance, just let me ask this for clarity. So if you were to pass any time in that term life, that will take care of whoever the beneficiaries are. That's practically how that goes.
Absolutely.
So it's probably good to at least have a term life, policy at least going.
Absolutely.
Okay, so that covers everything.
Correct. So just in my example, I mentioned that I have $2 million in life insurance right now. My investments are not $2 million. So during that time of that 25 years, if I pass away, then my family gets the $2 million life insurance policy, and whatever we have in our investments that are growing now, right? So they get both sides. If in another 20 years, when our policy is over, their investments will be grown, to the point where we don't need that much of coverage. So it won't make sense to spend that amount of money on life insurance later on. It's really similar to car insurance. When you buy a brand new car, it's required to get full coverage on your car, right? So if anything happens, you have a total collision, whatever, then the company's going to replace that car. When that loan is paid off, if you decide you no longer want the total coverage, then and you didn't have the accident, then of course it doesn't pay out. Term insurance works exactly the same way.
Is it possible to get both insurances, or it's not possible?
It's possible, but it's not necessarily wise. Because some people do. Some people get a term policy and they get a cash value. What happens with those cash value policies again? If the goal is to invest and grow your savings, then it's
like you're robbing money from one place when you can just have one thing and then put it in a compound interest Roth account and let that do what it needs to do.
Yes.
Instead of wasting money on one.
You're not wasting, you're losing.
You're losing it. Yeah, because the money's going somewhere, but the insurance company's getting it.
Going somewhere, but not you.
Right. Exactly.
Okay, so I do remember you saying that there's a cash value one and then there's the long term one.
Mm-hmm.
So is there any way that if we decided to get both, and we said it's highly unnecessary or risky, but if we happen to get both, could we possibly take the insurance from the cash value and put into the long one to make it an even investment, if that makes sense? Is that making any sense?
So Just to answer your question, because we help clients all the time who bought cash value policies, right? And what do you do with that money that's there? What we do is we help them to actually roll it over or to cash it out. You can cash it out anytime, and then put that into an actual investment. So it's just start your investment at a higher amount, and let it grow at a higher rate versus growing at that low rate that was in the policy.
Did my question make sense though?
Yeah.
Okay.
Yeah.
All right, okay. Cool.
Yeah. So in a real life example, my son had one of those Gerber Life grow up plans, and he's 18, and so for 18 years, for 18 years, my mama had this plan for him, and it only had grown to $5,000, and she was paying the premium every single month for 18 years. Had that same amount, we looked at the calculator, had that same amount been put into a mutual fund, I think it would be close to $1 million now. So that's just one example. Yeah.
That hurts.
Yeah. Yeah. Yep. So it's just we learn how to work smarter, not harder, and because a lot of this, like I said, there's a lot of myths out there that talk about the $1 million millionaires make money from borrowing from their policies. That's baloney.
Yeah, because that's a lot what's also on TikTok.
Mm-hmm.
Like, there was this. I'm not, I just keep myself aware. So you have a millionaire like a dude named Waka Flocka says he borrows against his life insurance all the time. He says that's what all the other rich people do. But I don't necessarily think that's how it works, and then they just pay themselves back. Like, I don't think that's how it works.
Yeah, I mean,
just for clarity for those who may have heard that.
Yeah.
It's like, oh, you can borrow from your life insurance all the time. That's what everybody does. So can you give clarity to that for people?
Definitely, if you think about it, financial sense, it doesn't make sense to wealth and debt in the same thing. You should not be borrowing against your policy, borrowing against something because if the purpose of life insurance is to protect your family when you pass away, if you're borrowing against that, then that's counterproductive. So the true money is and the true wealth is generated from investment, where your money is actually working for you versus working for an insurance company. Because on the back end, what's not being told is when people do take out those type of policies, that the insurance company, that you're actually insurable interest on that insurance company. So that most of the time they take out a term policy on you on the back end. And then they're investing your money, so they're actually buying term and investing the difference on the back end of your IUL. Yes.
Plus, you can only borrow up to the limit of the value of your cash that has been built.
Absolutely.
So you can only borrow up to the amount that your cash has been built up to. So if you have $100,000 policy, and your cash value that is built up is only $10,000, you can only borrow up to $10,000.
Right.
And so it's not like you're borrowing up to, like, you can borrow up on the value of the policy itself. You only can borrow up to the cash amount that it has been built up to.
Absolutely. And then the most of the time those policies, a lot of them have fees. So you're not only borrowing the money that's in the cash value, but you got to pay a surrender fee before you can even get that money. Yep. So it's not a good deal.
I have a question.
No problem.
Just for those who may have college background and learning how to save and dealing with student loans, what would be your best advice with those who are that can't really necessarily establish a savings, but they may want to have a savings in order to pay off their student loan? I don't know if that question makes sense, but
Yeah, it's real similar to what we were talking about. As far as the debt stacking and looking at, and you can even put the student loan into the equation. First of all, find all these wonderful programs out here with the student loan payoff. Definitely look into those as well. I'm a testimony. My student loans were paid off, through one of those Biden programs. I just got an email that said your loans were paid off. I don't know how it did it. I just know God did it, and I just said hallelujah.
Was it the SAVE plan?
So I did, like I said, it's nothing that I applied for. I actually just got an email said your loans are paid off.
Well, look at God.
So
Bring it this way.
drip, drip.
Sorry, I do have a question though.
Yes.
So some jobs, well, my job, they pay a $75,000 life insurance for all of their employees.
Mm-hmm.
So what does that look like? Like if I was to pass away, do they get a cut from that or?
So good question. We always say job insurance is good to have. It's like the icing on the cake. You want to have it, especially if they're giving it to you. Mm-hmm. One thing is most of the time the job insurance is not going to give you 10 times your income, and so it's not enough. But also, what I didn't understand, and because I was one of those people. I had $250,000 in coverage on my job, but they own it, and they can take it away. And so that's the part that it's good to have, but you also want to have something that you own as well. And then also if they decide to change benefits, because realize all benefits cost the employer money. Mm-hmm. And so every year it's up for grabs that they're going to keep those same benefits going on. That's one. And then also if you ever become injured, if you become ill and you have to go on disability, you're not considered an active employee. So if you pass away, the life insurance is not guaranteed to pay out on the job. So okay. That's a lot of times people don't think about it. Anybody else?
I plan on retiring in 2 years.
Hallelujah.
I plan. Now, we do have a 401k, and they match and everything like that with the government. But we was talking about mutual funds and Roth IRAs. Since I'm planning to retire in 2 more years, which one should I get into right now?
So good question. We do mutual funds. We do Roth IRAs. We also do annuities as well. So for someone who's retiring and you want to have an income that pays out, but you not necessarily want the interest rates to be fluctuating up and down, the safer bet for someone who is ready to retire, and you have a large 401k, is to put it into something that's safe, like an annuity. That's a fixed interest rate. Most of the time, it's around 7-8%. So that way, it'll you can set it so that it pays you like maybe 4 or 5 years down the road, start paying you an income coming. So that's what we always advise folks who are getting ready to retire. We also folks who are if federal employees. Actually, one of my first clients was a federal employee, and she retired. What happens is that they only have life insurance with the employer, which is great. But when you reach retirement age, it's based upon your age at that time, and so most federal employees can't afford the premiums when they retire. And so, like, one of my first clients was a federal employee from my former agency, and we covered her when I first got licensed, like probably the third or fourth client. That was in December of 2021, and then that following July, she had a heart attack and passed. So she was our first death claim. So thank God we were there, because she had something in place. So. It's powerful. A lot of times we think about we want to think that the government is going to take care of us, but we don't want to leave it up to them. Yeah. Exactly. All right. Well, if anybody has any other questions, feel free to let me know. We can always connect with me, and we can actually look at your individual cases, and get you if you don't know your financial independence number, we can help you to know at least know what it is, know what you're shooting for to retire. All right. Thank you.
Y'all please give it up for Brian. I'm telling you, listen, I'm glad you guys stayed. Those of you watched online, I'm glad that you watched online, and it's going to stay online for those of you who need to hear it and see the thing again. Like I said, Brian, I know him for a long time. A good man of God, man of integrity. So if you want to meet with him, meet with him and his wife. They are good people. They know what they're doing. Again, you heard it from him that he's also studying for that, and we're praying that he gets it because, again, it's amazing, which he will. But like I said, we're just trying to make sure that we get our church and the people of our church get educated, that you know what's going on. This will not be the last time that this happens. We'll be having this all throughout the year. We're going to bring in, the next thing we're going to bring in is those who are looking for a home and stuff like that, with first-time home buyer information and all that stuff. So all year, I am making it a big thing so you can be educated on how to get yourself ready, educated as far as finances and what you need to do. All right? Amen. Y'all have a good day. Oh, yeah, if you take, the literature is over there. If you do a screen, if you QR code right there, you'll also get the book of how money works as well. So you can also see what goes down. And it's a really good book. I have the information because Brian showed all this to me first, and I was like, oh, this is a very good presentation. We need to bring this to the church. So I finally got Brian here. Amen. And so you can go and QR code that. And also he got stuff over there as well, some good information. So please take information and share it with somebody. All right? And contact him because he's good. All right? Yeah, paper card too for old school. Amen. All right.